Let's jump right into this rapid-fire explainer on the absolute ground truths of credit risk and yield spreads. I'm definitely putting on my seasoned expert analyst hat today because we're getting into the real mechanics here. Whether you're prepping for a massive finance exam or you just want to decode what the market is actually pricing in when things get wild, you need to understand the gears turning beneath the surface of these credit markets. Because, look, this isn't just about whether a company goes bankrupt. It's about how every single tick of risk translates into real dollars and cents. Okay, let's dive into our syllabus for this masterclass. We'll be covering 5 key areas: anatomy of credit risk, the expected loss formula, decoding credit spreads, economic cycles and ratings. And then we're going to wrap the whole thing up with some rapid-fire CFA practice scenarios to really get you exam ready. First up, Section 1, Anatomy of Credit Risk, Understanding the Ground Truths of Risk. Now, to a professional analyst, credit risk isn't just one big, scary monster. It actually has 2 distinct, highly measurable dimensions. You've got default risk, and then you have migration or liquidity risk. Default risk is the extreme case, right? Think of it like a friend completely ghosting you on a $1,000 loan. They aren't paying you back, they've blocked your number, the money is just gone. But migration and liquidity risk, those are far more common. This is when the quality of the borrower deteriorates, even without an actual default. Imagine you own a really rare collectible. If rumors spread that it's a fake or the market just suddenly dries up, you have to slash the price to sell it. The borrower hasn't defaulted, but your asset has still lost real value. Examiners absolutely love to set traps here by making you think credit risk only means bankruptcy. It definitely doesn't. Moving on to Section 2, the expected loss formula, pricing the risk. So seasoned pros don't just sit around talking about abstract fears. We quantify them. We need to know exactly how to calculate the cash at risk. And the market calculates this using a very specific formula. Expected loss equals the probability of default multiplied by the loss given default multiplied by the exposure at default. Let's break that down. Probability of default, or PD, is just the likelihood the issuer actually goes bust. Loss given default, LGD, is the percentage of your money you'd lose if they do default. And finally, exposure at default, EAD, is your total amount on the line. Let's bring this math down to earth with some really simple logic, okay? Say you have an exposure of 1,000 rupees. The firm has a 5% probability of default. And if they default, you estimate you'll lose 60% of your money, meaning the loss given default is 60%. So 5% times 60% times 1,000 rupees gives us an expected cash loss of exactly 30 rupees. That 30 rupees, that is the precise expected loss the market is going to price in. Section 3, decoding credit spreads, what the market is actually pricing. Now that we know our expected loss, we need to see exactly how the market compensates us for taking on that risk. For all the junior analysts out there, always remember this. The yield on a corporate bond minus the yield on a safe government bond equals your credit spread. And what's really interesting here is that a credit spread is not purely made up of default risk. It's actually a fracture of several different premiums. When you look at that extra yield you're getting, yeah, you are being compensated for default risk, but also for liquidity risk, general market risk aversion, and even tax differences. This is a massive conceptual hurdle. Not all spread is pure credit risk. So the absolutely crucial point is understanding the critical inverse link between yield and price. Look at this scenario. A stable firm has a yield of 7% and a bond price of 1,000 rupees. Suddenly, the market gets spooked. The firm hasn't defaulted, but risk definitely increases. The required yield shoots up to 9%. What happens to the price? Bam, it immediately drops to 920 rupees. As credit risk rises, spreads widen, yields go up, and bond prices literally collapse. And this brilliantly illustrates how analysts view the capital stack to determine that risk. Not all debt is created equal, right? Senior secured debt has the lowest risk. Below that is senior unsecured, then subordinated debt, and finally equity sitting at the very bottom with the highest risk. Why does this matter? Because higher seniority means you are literally first in line to get paid during a bankruptcy. That means a lower loss given default. And as we just learned from our formula, a lower LGD directly translates to a lower overall expected loss and credit risk. Section 4, Economic Cycles and Ratings, Macro Market Dynamics. Okay, it's time to zoom out from the math for a second and look at human psychology and see how this builds into the broader economy, because the macro environment changes everything. Credit spreads are countercyclical. During an economic expansion, times are good, default risk is low, and investors are brave. They don't demand much of a premium, so credit spreads narrow. But in a recession,
Panic sets in, default risk is high, investors run for the hills, and they demand massive premiums to hold corporate debt. Because of that, credit spreads widen sharply. Remember that phrase, counter-cyclical.
On a slightly more advanced note, analysts basically use two main types of models to predict these defaults. Structural models, like the Merton model, look right at a firm's balance sheet. They say a default occurs purely if the firm's asset value falls below its total debt. Reduced form models, on the other hand, don't look inside the company. They look outside at the market. They use market data, like current spreads, to treat default probabilistically. It is highly testable material to know the conceptual difference between those two. To really anchor this in reality, let's just look at the 2008 global financial crisis. This was a textbook example of severe real-world stress. Investors completely panicked and started dumping risky bonds left and right. The demand for higher yields skyrocketed. As a result, credit spreads widened out to historic levels, and bond prices absolutely collapsed across the board. That downgrade risk hit portfolios aggressively long before the actual waves of bankruptcies even finalized. All right, Section 5, CFA Practice Scenarios, Rapid Fire Assessment Time.
Time for a quick pop quiz to test your readiness. Let's keep the energy high here. We're simulating the actual pace of an exam. Let's see what you've retained. Question 1. Which component directly affects expected loss? Is it A, coupon, B, LGD, or C, duration? Think back to those three formula variables we broke down earlier. And the answer is B, LGD. Loss given default is a direct multiplier in the expected loss formula. Remember, probability of default times loss given default times exposure at default. The coupon and duration simply do not factor into that specific expected cash loss equation.
Moving right along to question 2. Credit spreads tend to A, narrow in recession, B, widen in recession, or C, stay constant. Think about human psychology and that countercyclical rule we just discussed.
The answer is B. They widen in a recession. When the economy shrinks, panic rises. Investors demand far higher premiums to compensate for the elevated risk of corporate defaults, pushing those spreads out significantly. Question 3. A credit rating downgrade will A, increase bond price, B, decrease bond yield, or C, decrease bond price. Focus on that inverse relationship between yield and price. The answer is C, decrease bond price. When a bond gets downgraded, the market perceives it as riskier. Therefore, investors require a higher yield to hold it. And as yields go up, bond prices must instantly drop. This hits your portfolio long before any default actually happens. Final rapid-fire question. Which bond has the highest credit risk? A, a AAA-rated bond, B, a BB-rated bond, or C, a BB-rated bond? Think about the rating scale and where transition risk leads us. And the answer is C, the BB-rated bond. AAA is the gold standard. BBB is the lowest tier of investment grade. But once you slip down into BB territory, you have officially entered the high-yield or quote-unquote junk bond category, a place where yields are high but default risk is severe, and honestly, maybe your stress levels are too. Congratulations on surviving the practice round of this explainer. I want to leave you with this final, absolutely vital takeaway to guide your thinking moving forward. Credit risk is not just about whether a company defaults. It's about how the market continuously reprices that possibility. Keep looking at the market through the eyes of an analyst. Every headline, every macro shift, every rating change is instantly being repriced into the yield spread. Master that concept, and you've really mastered credit risk. So I'll leave you with this to chew on. Based on today's headlines, what is the next macro shift the market is completely mispricing right now?